as part of this, it is time for us to adopt a new company brand to encompass everything that we do. To reflect who we are and what we hope to build, I am proud to announce that starting today, our company is now Meta.
Yeah, D, if you look across the tech sector now, these losses are adding up. The top tech billionaires, top 10 losing over $500 billion in wealth this year. Elon Musk down $60 billion, Bezos down $55. But no one tops Mark Zuckerberg. He's down $75 billion so far this year. That is one of the largest wealth losses in history in dollar terms. He's down $90 billion from his peak last September. Now, to put that in perspective, he has lost the total value of a GM and a Ford in market cap combined.
All right. Today is Tuesday, the 11th of October. This is a recap for the stock market activities today. And folks, I got a good one for you tonight, but we're gonna start with the breaking news. We just heard that Intel is about to lay off thousands of employees. Matter of fact, 12,000 employees, according to the information that I got right now. Here comes the tsunami of layoffs. We know there is a massive weakness in the chip sector in the economy, and we're now seeing the ramifications translating from the stock market all the way to the real economy. And speaking of the stock market, today it appeared that we might catch a break. We might see the stock market trading higher, and this came on the heels of the Bank of England expanding its bond purchasing program. And this gave the US stock market some hope that perhaps the Federal Reserve might come to the same conclusion at some point. However, by the end of the day, the governor of the Bank of England, Andrew Bailey, dropped a bombshell by saying that his message to the funds involved in the United Kingdom, you got 3 days left now. In other words, the Bank of England governor is giving all of these funds 3 days to rebalance before the bond purchasing program is over. And boy, if you're watching the show this evening from the United Kingdom, buckle up, because it is just a matter of time before the financial accident happens. When it happens, it's going to be contagious. Other European countries, such as Germany, will get hit next. And little by little, the contagion will spread all the way across the Atlantic here to the United States of America. There is no escape here. But folks, I know that this channel is, well, it presents some reality. And reality these days is very dark and upsetting. And therefore, some viewers say, hey, Maverick, what are you, the Prince of Darkness, doom and gloom all the time? How about some uplifting news once in a while? So here's some uplifting news for you. Dating is really hard these days. And we're not talking about women, we're talking about men. Dating is becoming really hard for men. You know why? Because we have these weird trends that happen in online dating. And thankfully, I don't have to deal with that. But these days, women have a height requirement. You gotta be above a certain height. Otherwise, you're not dateable. So we have this poor guy who walks in a bar and approaches the ladies and starts flirting with them and immediately gets rejected, and the ladies say, honey, you're too short to date. Kind of too short for my taste. So the poor guy borrows $75,000 for a leg lengthening surgery to give him extra 3 inches. And I don't know if you're familiar with these surgeries or not, but they actually have to break your bones and then add rods and lengthen the leg, which makes it thinner, and then stitch it up and say, hey, you got 3 extra inches. Congratulations, your life is about to change. And then the poor guy walks into the bar once again with his new acquired height, approaches the ladies, starts flirting with them, and what do you know, he gets rejected again, this time around for having chicken legs. But rest assured, this guy could have better dating prospects in the Metaverse, because the Metaverse is a legless world. No legs required at all. Matter of fact, nobody has lower bodies in the Metaverse. Can you imagine how the Kardashians are going to do in the Metaverse? They're probably going to be the poorest family.
Like the no legs thing in here, honestly, I don't know why they have that, because The no legs thing is just, it feels weird seeing you standing in a standing position over here with no legs.
Yeah.
Or no lower half.
The desk and the chairs also don't have legs, so maybe it's a limitation.
The reason for that is because it's hard to track your legs with the Oculus. The Oculus Quest has cameras all around this frame, so it's easier for it to track your body, but then it gets tough with legs.
And look, I don't have everything. I don't have all the features. I'm not lucky enough to have everything, but I do have something. There is something I'm famous for, and it's my big and beautiful large calves. And that's how I used to pick up chicks back in the day. So I refuse to join the metaverse. I'm not moving to the metaverse without my best features. Otherwise, nobody's gonna like me over there. But rest assured, if you've been hitting the gym leg day after leg day after leg day, your leg gains are not gonna go to waste in the metaverse anymore. Because today we heard that the metaverse will include legs for the first time ever. The problem is, does the metaverse has any legs to stand on? And this is the main subject of tonight's program. So here it is, in focus tonight. Zucked, how Mark Zuckerberg is disrupting himself into oblivion. While we got the announcement finally that the metaverse will include legs for the first time, and you can use any kind of legs you want, you can shop for trousers and pants, shorts, whatever you need. That's the good news. The bad news is the company itself, not just the metaverse. The company itself, Meta, which used to be known as Facebook, has absolutely no legs to stand on anymore. This year so far, we got the report that Facebook has lost users for the first time in its history. And on top of that, we're seeing massive slowdown in the growth engine for the company formerly known as Facebook. The growth engine was Instagram. Well, now Instagram is a ghost town, and it's boring. It's for boomers, bro. Nobody uses Instagram anymore. It's all about TikTok, right? And in the pursuit of copying TikTok, Instagram made significant mistakes, and they got caught by none other than the Kardashians, saying, hey, stop copying TikTok because you're losing focus in chasing TikTok and you're making Instagram unusable. Not to mention that Facebook and Instagram are no longer fun to use with this new content moderation thing that's going on, which is basically boils down to if you say the things that we like and we agree on, no problem. If you challenge the official narrative and you have your own opinion, we got a problem. We're going to ban you, we're going to gag you, we're going to kick you out of the platform. And of course, Mark Zuckerberg has been spending like a drunken sailor in making sure that his platforms are no longer fun to use with all of this content moderation and censorship. Matter of fact, Mark Zuckerberg has been hiring ex-government goons from the CIA to monitor the content on Facebook and Instagram. So it is no wonder why we're seeing this massive exodus out of Facebook and Instagram, and this is hurting Meta, the company, significantly, to the point where the stock of Meta crashed, and it is the largest stock market crash in history when we look at it from the scope of market cap. The largest market cap loss in history. And of course, this impacted the net worth of Mark Zuckerberg. He went down by over $70 billion. Once again, the largest in history. And while Meta, the company, continues to bleed cash, the latest figure we heard is $2.8 billion in the pursuit of this fantasy we call the Metaverse. The lunacy for Mark Zuckerberg, who firmly believes that we're going to end up living in virtual reality. And he wants to be the one who owns virtual reality in what we now know as the Metaverse, which in my opinion is nothing more than a glorified video game. And this is not just my opinion, it is the opinion of insiders in Meta. You see, Mark is undeterred. He's gonna go all in the pursuit of his dream that is called the Metaverse, no matter what the consequences are, no matter what the cost is, because Zuckerberg is hell-bent that the Metaverse is the future. And there is no other choice. There is no possibility that he might be wrong. And this is where the ego of the CEO collides with reality, actual reality, not the virtual one. And the problems in Metaverse land, they're countless, and they continue to grow by the day. Even Meta's employees are not thrilled about Mark Zuckerberg's Metaverse chase. We'll talk about that a little more in a minute, but the Metaverse also has quality problems. The Metaverse app suffers from drop-downs and glitches all the time, and even employees are not using it enough. And now Mark Zuckerberg and management and Meta are begging their employees to use the Metaverse. And perhaps this explains why Meta's own employees are not even using the Metaverse. How about because they don't even have the VR headsets? So Mark says you gotta use the Metaverse, everything in this company has to be done using the metaverse, yet employees don't even have the headsets. What's going on here? How about skepticism, confusion, frustration? And this is the headline from the New York Times. Inside Mark Zuckerberg's metaverse struggles. Mr. Zuckerberg's zeal for the metaverse has been met with skepticism by some Meta employees. This year, he urged teams to hold meetings inside Meta's Horizon Workrooms app, which allows users to gather in virtual conference rooms. But many employees did not own VR headsets or hadn't set them up yet and had to scramble to buy and register devices before managers caught on, according to one person with knowledge of the events. In September, Vishal Shah, the vice president in charge of Meta's Metaverse division, wrote on an internal message board that he was disappointed in how few Meta employees were using Horizon Worlds, according to a post obtained by The Times. In his post, which was first reported by The Verge, Mr. Shah said managers would begin tracking workers' use of Horizon Worlds and said that testing their own technology was essential. Why don't we love the product we've built so much that we use it all the time? Mr. Shah asked. The simple truth is, if we don't love it, how can we expect our users to love it? Mr. Shah, who declined to comment to The Times, also said in his post that Horizon World undergo a quality lockdown, quote-unquote, for the rest of the year to raise the overall craft and delight of our product, quote-unquote. And the problem here, folks, is Mark Zuckerberg has his own vision of the world. He has his own dream called the Metaverse, but he has yet to convince anybody that this vision is worth it. This vision is the future. He couldn't even convince his own employees, let alone us. And now the environment in Meta is becoming that of a dictatorship, where you have to obey the will of Mark Zuckerberg, whether you agree with it or not, whether you understand it or not. It doesn't matter. Either you're in or you're fired. And this is happening to the point where actual employees in Meta are now calling key metaverse projects MMH. Make Mark happy, as a nod to Mark Zuckerberg's changing priorities. What are they talking about? And back to The Times. In a May poll of 1,000 Meta employees conducted by Blind, which happens to be an anonymous professional social network, only 58% said that they understood the company's metaverse strategy. This is disastrous. Employees have also grumbled about the high turnover and frequent shuffling of employees as Mr. Zuckerberg's priorities change. Inside Meta, 2 employees said some workers now jokingly refer to the key metaverse projects as MMH, an acronym for Make Mark Happy. As the pressure grows, Mr. Zuckerberg has sent a clear message. Listen to this. This is really important. He sent a clear message to Meta employees. Get on board or get out. In a June meeting first reported by Reuters, the 38-year-old billionaire noted that there are probably a bunch of people at the company who should not be here, end quote. Most importantly, that he'd be turning up the heat, quote unquote, on expectations and goals according to copies of his comments that were shared with The Times. Since then, the company has frozen most hiring, reduced budgets, and Mr. Zuckerberg asked managers to start identifying low-performing employees. The environment in Meta is becoming that of fear, that maybe I, as an employee right now, could become the next victim of my boss's mood swings and changing priorities. He's not even getting us in the board of this metaverse pursuit. This is what Meta's employees are saying right now. Faced with the possibility of layoffs, some Meta employees have started to convey more enthusiasm for the metaverse, meaning the employees are faking their enthusiasm out of fear that Mark Zuckerberg might give them the you're fired next. Mr. Zuckerberg is losing allies and employees as he continues to get rid of anybody who challenges his dreams and fantasies, perhaps. Meta CEO Mark Zuckerberg is derailing right in real time. And ladies and gentlemen, this is the beginning of the end of Mark Zuckerberg, in my opinion. Mark got rid of his team. He has Sheryl Sandberg there. Well, not anymore. He had some senior mentors on the board. He pushed them all out. Most importantly, listen to this. He's got a group of young people that are more like Mark's followers, meaning obedient employees. Yes, sir, your dreams are great. The metaverse is the best thing that ever happened to humanity. It is an environment of fear and intimidation in Meta. It is too bad that Mark is really derailing right in real time, and I think, frankly, the wealth went to his head. Once you start chasing money, being the wealthiest guy around, we have seen the dangers of that. And most importantly, perhaps Perhaps Mark Zuckerberg is making the classic mistake that Marissa Mayer did in Yahoo. Remember that one? Meanwhile, Meta is pouring time and resources into the metaverse and hemorrhaging money along the way. The company lost $10 billion on its big bet in 2021, a significant sum even by Meta's standards. And Zuckerberg told shareholders this year that the trend will continue for the next 3 to 5 years. In other words, please dump my stock. And this is the classic mistake by Yahoo. Listen to this. Yahoo, too, was an advertising behemoth. By 2004, the company was netting $3.5 billion in revenue and had a market capitalization of $128 billion. But competition started heating up from rivals like eBay and Google, and later, ironically enough, Facebook. And ad dollars soon began to dry up. And by 2012, Yahoo's worth had plunged to around $20 billion. It lost more than $108 billion in market capitalization. And now with Yahoo facing all of these problems, Enter Meyer, who was tasked with restoring Yahoo to its position as one of the world's preeminent tech firms, one that could rival Google, Facebook, Apple, and Amazon. Meyer's bet was as bold as they were unfocused. This is the parallel between Yahoo and Meta. People say, hey, Meta is not going to end up like Yahoo. Be careful what your assumptions are, because at some point Yahoo was one of the largest tech companies in the world. I would say one of the top 5. Now it's nothing. Continuing, Meyer decided to make Yahoo an app for everything. She hired Katie Couric for $5 million a year, create scripted shows like Netflix, buy blogging platform Tumblr for $1.1 billion. But none of those big bets paid off. 2 years after she arrived, Yahoo's exciting turnaround had not materialized, and the company's revenue remained stagnant. In 2016, the era of Yahoo operating as a standalone company came to an end when Verizon paid $5 billion to acquire Yahoo and merged it with AOL. Meyer stepped down as CEO. So what is the lesson here? When you have an egotistic maniac as a CEO and they have their own dreams and ways of how this company is going to operate, and they have no desire to listen to any feedback, even from their own employees, things can go wrong quickly. And this is exactly what's happening in Meta. Meta employees who spoke to the Times described frequent strategy shifts that seem rooted in Zuckerberg's desires rather than a concrete data, as well as Zuckerberg's willingness to spend vast sums of money on projects that had no guarantee of success. So much money that former Oculus executive John Carmack said it made him sick to my stomach, quote unquote. Similarly, at Yahoo, Meyer was described as making decisions with her gut rather than data, like when Yahoo paid as much as $10 million per year to host Saturday Night Live archives, or when it hired Katie Couric as the site's global anchor, quote unquote, even after her earlier videos for the site flopped. Again, making decisions based on ego rather than data and numbers. She thought Katie Couric was great. She thought Saturday Night Live was important, and she was willing to spend the company's money like a drunken sailor. We all know how that ended, and the same is happening in Meta. And on top of that, the cultures are eerily similar. Then there is the company's culture. Meyer implemented a controversial performance ranking system during her tenure, intended to inspire hard work and sniff out underperforming employees. But it backfired, surprise, surprise, leading to a frustrated workforce and low morale. Let me tell you something here. I used to do consulting for small startups, specifically in SaaS, these small software startups, and they would hire me to figure out what's going on wrong in the company. And more often than not, the problem is not the product itself, not the company's strategy, and not even the implementation. More often, the company's problem is its culture. For example, I walked in one of these software startups. We were shaking hands. They hired me as a consultant. I was walking around to see what's going on. And the first thing that stuck to me is a giant board, a giant scoreboard with a bunch of names on it, and they're all ranked. And I asked management, what is this all about? And they said, this is the monthly performance of our employees. And those who rank at the bottom, they end up losing their jobs by the end of the month because the company was in a financial crunch. And I thought, no wonder why the company is underperforming. You're pinning your own employees against each other. What a genius idea. Meanwhile, the CEO, the CFO, all of these executives, what are they doing? The guy has a bike. This is before Peloton, but he has a bike at the office with the glass walls. You can see what's going on there. The employees downstairs can see the CEO biking, having a good time, listening to music while they fight against each other downstairs. You think this is good for the morale of the company? Of course not. But anyways, back to the article. If Zuckerberg is right, and the metaverse is the future. These moves are prudent and will help propel Meta ahead of the competition. And there is reason to believe his ambitious plans will work. After all, Zuckerberg already reinvented Facebook once he foresaw the shift from desktop to mobile, a strategy that even his former number 2 Sheryl Sandberg thought was risky at the time. But this is the most important take. But if his bet doesn't pay off, then we could see Meta go the way of Yahoo. In other words, extinction. And speaking of Sheryl Sandberg, she used to be known as the adult in the room. Mark Zuckerberg was too young when Facebook became public, and investors had confidence that we have Sheryl Sandberg who will keep Mark Zuckerberg in check, so his ambitions don't go too far and he can concentrate on the financials of the company because this is what investors really care about. Unfortunately for Zuckerberg and Meta, Sheryl Sandberg is gone now. She's out. And of course, people say she wants to concentrate on philanthropy, she wants to concentrate on her new marriage and family, or maybe she had her own share of scandals that she's running away from. I say maybe this, maybe that, who cares? But the real reason, in my opinion, goes beyond that, and it has been brewing for a long time. The older Mark Zuckerberg got, the more ambitious, the more confident, but most importantly, the more assertive he became. And of course, he wouldn't listen to Sheryl Sandberg anymore. I believe that Sheryl had the vision that Facebook will become an ad behemoth, and it was a profitable company. It was the leanest company for its size, meaning it was not only generating an insane amount of revenue, but it was generating an insane amount of growth of revenue year over year, month over month, quarter over quarter. It was a growth behemoth. On the other hand, it didn't have a lot of costs and expenses. The ad business is lean. There is no product. The input cost that you have is your employees. You don't have a lot of input cost, and therefore investors loved Facebook stock and invested billions and billions of dollars in the company. And in my opinion, I believe that Sheryl Sandberg believed that the direction of the company should be dominating the ad business and getting ahead of the competition. But this is where the collision happened. Mark believes in the metaverse. He doesn't see the business as an ad business. He sees it as connecting human beings, and the metaverse is the next stage of connecting human beings. And Sheryl had to go out. There's no point of being together at this point when you have different visions of the company. I mean, what the hell is this?
And understand tone. Things like raising an eyebrow, squinting, widening my eyes, or scrunching my nose. These avatars are way better at capturing those subtleties that define physical interactions. They're just much more natural. And being able to control the lighting on the avatars adds another dimension of life to them. When we move the light around, you can see how it interacts with my hair, or reflects on my skin, and you can even see it in my eyes.
But besides being creepy, Mark Zuckerberg today debuted the Quest Pro VR headset. And guess what? The price tag is at $1,500. This is insane. This is more expensive than an iPhone. Who the hell can afford this in a slowing economy? And if you thought that perhaps the price is worth it because Meta and Mark are going to make more money now, the margins are going to be really high from these headsets, you're sadly mistaken. Meta will actually lose money by selling these glasses at $1,500. Take a look.
You've been pretty open that on the Quest 2, you are not making money on the hardware. Are you making money on this, like on a unit basis, or?
I mean, I'd have to look. There are lots of different ways to basically do the accounting on this. As
I guess is this a profit-generating device for you? Okay.
I think the strategy overall is not to make money on the hardware, but to make it so that it can help develop the ecosystem. And then over time, the business model will be based on software and services. So that remains the approach.
And this is the bottom line, folks. When viewers ask me, what about Meta stock? What do you see? Why is it down so big? The answer is clear. Meta used to be valued in the stock market as an ad business, a lean company. But now the market doesn't view Meta as an ad company, an ad stock. It now has to be repriced into a VR hardware company. And this alone crushes the valuation of the company, meaning if Mark Zuckerberg continues in his pursuit of the metaverse, the market will continue to assign a low multiple for Meta, not the same high multiple the market was used to when Meta was thought about as an ad business. Now we'll prove that to you in a minute. We start with the profit margin. It is declining. The trend is down. Why is the profit margin of Meta dropping down? The answer is they're moving from a lean ad business to an input cost extensive hardware/VR business. But most importantly, the metric that I like to use, my favorite, the operating margin. Why do I like the operating margin? Because it is, in a nutshell, what the company keeps from every dollar generated as revenue after paying their expenses besides taxes. Taxes can change, so the operating margin gives you whether the company and its operations alone doing good or bad. How much are they keeping from each dollar generated in revenue? So when you see 30%, 40%, this is how much they keep from each dollar generated in revenue. When we look at the operating margin of Meta, it is at the lowest operating margin ever for the trailing 12 months. It now stands at 29. In 2015, it was 35. In 2016, it used to be 45 almost, meaning the company keeps 45 cents of each dollar generated in revenue. Not anymore. Now the company barely keeps 29 cents of each dollar generated in revenue, and the reason is the company spends more and more and more in the pursuit of this metaverse fantasy. And if that was not enough to prove it for you, look at the contrast in performance between Meta and Google. Meta in red, Google in white. These two stocks almost overlap with each other. Both used to be thought about as ad businesses. Well, Alphabet, aka Google, is still an ad business. And therefore, even after the stock market rout that we're getting so far this year, the drop in Google stock is not as severe as the drop in Meta stock, which is absolutely disastrous. This is the widest gap that we have seen in the performance of these two stocks ever. Why, you might ask? The answer is simple. One is still an ad business. The other one is no longer an ad business. The other one is, who knows, a hardware company, a VR company, a metaverse company, a video game company. We don't know. But it is certainly not an ad business anymore. This is not the scope and the focus of the business anymore. This is not what the management of this company is aiming for, to dominate the ad business. The company is now in an entirely different direction called the Metaverse. And either it's going to work and it's going to pay massive dividends for Mark and the company, or it's going to be a massive flop and this will be the end of Meta and Mark Zuckerberg. But rest assured, if this made you feel bad for Mark, I say don't feel bad for him, because Mr. Zuckerberg already knew what's going to happen. He knew that his gamble is dangerous, and he decided to cash out before all of this happened. Meanwhile, Meta investors are left holding the bag. Take a look.
He used to be the number 3 in the world. Now he is off the top 20. Now, he was able to take money off the table before that big drop. Last year, he sold shares almost every single business day for a total of $4.5 billion in sales. His average sale price was about $327 a share. That stock trading today below $130. About $4 billion was sold by the Chan Zuckerberg Initiative. That's his philanthropy and LLC. About $500 million were sold by his personal trust. Since 2012, Zuckerberg has sold over $17 billion worth of those shares. Now this year, he has not sold or purchased a single share, but he's also timed his real estate sales well, selling his San Francisco townhouse in July for a record $31 million.
And with that story out of the way, let's move on to cover the stock market information for you. We begin with the closing of the indices today, and here we go. The Dow Industrial Average closing in the green by 36.31 point, or a gain of 0.12%. On the other hand, the Nasdaq is down big, losing 115.91 points, or a decline of 1.10%. The S&P also down by 23.55 points, or a decline of 0.65%. The sector's performances today led by number 1 capturing the gold medal, REITs, number 2 for the silver, defensives, number 3 for the bronze, healthcare. On the other hand, the laggards of the day were led by technology, communication services, and financials. And what about the advance to decline ratios? NYSE 46% advancing versus 52% declining. The Nasdaq 38% advancing versus 59% declining. And the breadth is getting way worse by the day. Every single day, it gets worse. Today, we got 527 new 52-week lows in the Nasdaq. On to commodities. What's going on here? We have a pullback in crude, and of course, the theories are floating all over the place. Yesterday, we talked about the oil wars, OPEC Plus versus the West, mainly the United States. And this war is going to heat up. We might see oil prices surge significantly higher. But today we got a pullback on recession fears. We are going to see this dynamic continuing. If we have days where the headwinds are dominating, meaning the Fed's tightening, leading to a recession, dominating the news, crude will go down. But when we have headlines of supply cuts, crude will go higher. Today, both the WTI and Brent were down big. The WTI down almost 2.75%, Brent down 2.5%. Even the gasoline RBOB was down almost 1.25%. So was heating oil down by almost 0.75%. On the other hand, we have a rebound here in natural gas, gaining about 2.5%. And I do have a theory here because in the last few weeks, we have seen crude outperforming natural gas. Now we're seeing crude pulling back and natural gas rebounding. So we're seeing money shifting back and forth between crude and natural gas. Traders make a little bit of money in crude. They take these profits and they shift them to natural gas, back and forth. Back and forth. What about softs? We have a rebound for lumber, worth about 5% for the day. Huge volatility in lumber futures. And then we have another rebound in OJ. It appears that OJ futures are holding the gains from the hurricane in Florida, and today gained about 2.25%. Likewise, we have modest gains for sugar and cotton futures. On the other hand, modest declines for coffee and cocoa futures. Metals down across the board. The majority of declines are in silver, losing about 2.5% today. Palladium down about 1.5%. The dollar did not do much, but we have a metals recession. Metals are an indicator of a recession. Every time, once again, when we have recession dominating the news, you're going to see commodities underperforming, but specifically oil and metals. On the other hand, it was a good day for meats. While we have muted action for lean hogs, we got gains of about 2% for feeder cattle futures. Likewise, gains of about 1% for live cattle futures. When it comes to grains, we have a pullback for wheat. Wheat was up over 7% yesterday. Today, decided to give up some of those gains, down about 4%. Likewise, we have losses for soybean oil, corn, and canola futures, while we have muted reactions for soybeans, soybean meal, and rough rice futures. On the other hand, the gainer for the day was oats futures, up by about 2%. And when we look at the chart for oats futures, here was a weekly chart. Look at the MACD indicator. This is due for a reaction to the upside. It is down big. We're going to see some buying here, some dip buying. We might see an upside for oats that you might not want to miss on. But in the long run, and this is technically speaking, we're not using any of the fundamentals and the shortages in wheat crops. We're just using the technicals. If you draw a vertical line in the chart, the symmetry is unbelievable. You can almost fold the chart and it will overlap. And if the symmetry holds, whatever bounce we get in oats, it's going to be short-lived, and oats futures will decline all the way back to the trend of the pre-inflation era. But this is going to take a lot of time. Maybe you're going to see it in 24, 25. Moving on to the big casino, the options market, what do we see here? The volume remains down, but the hottest table is Tesla at around 1.6 million contracts traded today. About 54% of those were calls. If we have a rebound in the stock market for whatever catalyst, CPI, whatever it is, it doesn't matter. Tesla stock will lead the rebound, and therefore you have speculators betting ahead of time on this rebound, and they're buying more calls than puts. These happen to be swing traders, and when the premiums for puts explode out of whack because the stock has been crashing, they see the opportunity in buying puts as over, and instead they see the opportunity for the rebound as right now call options premiums a lot cheaper than puts. Anyhow, number 2, Apple, with around 900,000 contracts traded today, about 55% of those were puts. Traders continue to bet against Apple by the day. The bets continue to increase by the day. We're getting bad news from the chips industry. Traders put 2 and 2 together and say, well, Apple is the next shoe to drop. But at number 3, Amazon, with around 600,000 contracts traded today, about 50% of those were calls. On to the unusual activities that took place in the options market today. We start with the ticker NLY for Annaly Financials. The name popped higher today, and somebody's betting for more gains to come. They bought the 19 calls for the expiration date, November 18th, with expectations that the name could add more gains of over 12.5% by expiration date. They paid around 80 cents a piece to enter this trade, all in all spending around $2 million. And then what about the XHB, the Home Builders ETF? Somebody's betting for more losses to come. In other words, interest rates to continue to move higher. And they bought the 48 puts on the XHB for the expiration date, November 18th, with expectations that the name could move down and lose more than 16% of its value by then. They paid around 60 cents a piece to enter this trade, all in all spending around $900,000. And then what about the call spread for DKNG DraftKings? We have an upcoming catalyst in California, Proposition 26, 27, whatever it is, that should legalize online gambling in California, the largest market by far in the nation. The assumption for now is the proposition is going to flop, but before we get the results, you're going to see a lot of bets that maybe the proposition will pull a surprise and it's going to pass. And therefore, the trader bought the 15.5 calls for the expiration date, October 28th, and they sold the 14.5 calls for the expiration date October 14th. They paid around 50 cents a piece for buying the 15.5 calls. They received about 30 cents in credit from selling the 14.5 calls. The expectations here are maybe DraftKings will stay static, consolidating, or move down a little bit, or move up a little bit, but it's not going to be trading above 14.5 bucks by the expiration date of October 14th. But it will make it above 14.5 by the other expiration date for the long trade, which happens to be October 28th. All in all, the entry cost for this trade is reduced to about 20 cents a piece, and the traders spent about $180,000 here. And in my opinion, I do like this trade because the risk is defined, the trader knows what the expectations are, and they're placing the trades based on these tight expectations. And lastly, at the bottom of the table, what about the triple Qs, the NASDAQ? And this is a big one. Somebody bought the 244 puts for the expiration date, December 16th, with expectations that the Qs could move down and lose more than 7% of its value by then. They paid around $8.15 a piece to enter this trade, all in all spending around $6 million. On to the heat map. What's going on here? Lots of pain in chips, and this is becoming contagious. It's not chips that are down. Technology down. Financials down. Meta was down big today. Netflix was down big today. There is an exodus from all of these risk-on trades and risk-on investments. Yet on the other hand, we're seeing some rebounds and dip buying in the defensive trades. What are we talking about? We're talking about big pharma names. That is defensive. High yields. Little possibility of a recession happening in these names. Medicare is going to pay. People are not going to stop paying for medicine, etc., etc. Likewise, when it comes to defensives and consumer staples, again, whether we have inflation or a recession, are we going to stop buying food? Are we going to stop buying diapers for our kids from Procter & Gamble? Are we going to stop buying cereal from General Mills? Are we going to stop buying candy bars from Hershey's? The answer is probably not. Maybe we're going to slow down, but we're still going to buy them. And therefore, these names tend to outperform even in a recession. Now, that doesn't mean you have to buy them right now. They're going to go down if we have a crash, but they're going to hold a lot better and they're going to rebound a lot faster. So if you are looking to buy any dip here for a rebound trade, you're not really buying because you think this is the bottom, you might want to take opportunities in the dips in healthcare, in defensives, mainly the consumer staples, because money is going to buy the dips in these names over and over and over again. Likewise, we have defense contractors, Lockheed, Raytheon, Northrop, General Dynamics. All of these names will fare a lot better. Not Boeing though, because Boeing has a defense department, but the main business is cyclical, and it's going to slow down a lot if we have a global recession. And of course, energy is the last remaining bull market for now. Who knows when it's going to go down, but for now, it continues to be a bull market. And we have a lot of tailwinds. We talked about a lot of them in last night's video, the OPEC Plus video. You should watch that in case you haven't. Now, let's talk about the notable movers today. We're going to talk about DoorDash, Uber, Lyft, all of these gig economy sharing, whatever that is, they're all down big. And the reason is we have a proposal from the Biden administration right before the elections to make these workers full-time employees with all the benefits that entails. And this means more input cost for these companies, the likes of Uber, Lyft, DoorDash. No wonder why they're down big today. And then we have news from Honda, and Honda is finally joining the EV mania. A little too late, but better late than never, I guess. The stock is not going to find any benefit at this point, but they're announcing a new battery plant with LG, which will create about 2,000 jobs in Ohio. We'll see what happens, but I used to be a bull for HMC, Honda stock, earlier in the year. It was the only remaining value stock in automotive, but it also underperformed, and I ended up dumping HMC out of the portfolio at a loss. And since we're talking about automobiles, what about Mercedes-Benz? Well, there is no recession there. Business is actually booming. Sales are actually soaring. Why are we seeing this phenomenon? Certain corners of this economy are slowing down significantly, while corners where the affluent consumer spends, they're still doing pretty good. And this is the evidence right here. We talked about this in details in this channel before. The recession works its way from the bottom up. First, it hits the poor, and we're already seeing the poor class in a recession. And then the recession works its way higher and higher and higher, to the middle class, to the higher middle class, all the way to the affluent consumer. So the slowdown in luxury spending will happen, but it's not going to happen before we see the poor and the middle class annihilated first. And lastly, we have news for Target and Walmart. We're about to head into the holidays shopping season, Black Friday and such, and you might have noticed that traffic is increasing in Target and Walmart, all of these stores, because we've heard from these stores earlier in the year that they have excess inventory, they have oversupply, and they have to get rid of this oversupply by cutting prices significantly, even if it means they're going to lose money, and therefore the best deals are going to be in Target and Walmart, not in Amazon. So the market might view this as an opportunity to buy the dip in Target and Walmart in the meantime. Again, this is for a trade. It's not for an investment. The bottom is not here yet in Walmart or Target or the entirety of the market for that matter. But could we see the stocks of Walmart and Target outperforming all the way till the holiday shopping season for a week or two? That is certainly a possibility given how oversold these stocks are and how we're seeing and about to see increasing traffic for these retail stores. Moving on to the heat map for the ETFs, muted across the board, be it value outperforming growth. The majority of gains came from the defensive sectors of the market. We're talking about real estate, the IYR, we're talking about consumer defensives, the XLP, but we also saw the XRT performing since we've seen Costco, Walmart, Target outperforming today. The XRT also got a bump. The XLV, Big Pharma outperforming XBI, Biotech. And a notable take here is look at the inverse index for the XLF financials, the FAZ, shooting up big today. Meanwhile, the leverage index for the XLF, the FAS, while we have seen a lot of bets betting that the FAX could explode higher this week due to banks' earnings, we're not seeing this so far. In my opinion, if anything, banks' earnings are going to solidify the case for a recession. We have massive underperformance today from the international ETFs, led by the EWZ, the Brazilian ETF, and then the FXI, and all of these Chinese ETFs were down big today. And as we see Chinese ETFs go down, and the tit-for-tat war against China heating up, we see chips ETFs, the likes of the SMH, down big for the day, and even commodities couldn't perform for the day. They were either muted or to the downside. And despite all of this action, it remains the calm before the storm. What storm are we talking about? The answer is the CPI on Thursday. In the meantime, let's move on and cover some charts here. And we start with the SPY, the S&P 500 30-minute chart. What do we see here? Yesterday, it warned that the bull flag formation could be a false bull flag. Why? Because it couldn't make it above the so-called June bottom, which is 362.16. It couldn't close the day above this number. But most importantly, while a lot of you look at charts as candlesticks and patterns, I look at charts as a story. The market tells me a story about market psychology and how different parties are thinking. And when we look at the psychology and read it by looking at the chart, the bull flag pattern was simply the market asking for buyers, and the buyers did not show up, and therefore we got a gap down in the morning, and then the buyers did show up. Be it short covering or legitimate buyers, that doesn't matter. The end result is the same. And likewise, the psychology remains the same when the results are the same. In this case, the chart made it all the way to the June bottom, 362.16, and could not make it. It got rejected, and on top of that, it reversed the majority of the gains for the day and it closed at the lows of the day. Is this behavior bullish or bearish? Well, the bears are going to say, look, this is a double top, a double rejection from 362.16, aka the June bottom, meaning forget about it. The market needs to capitulate at this point and forget about recapturing the June bottom at all. The bulls are going to argue, but wait a minute here, this is a double bottom formation. It could be, or we could give it another shot at the June bottom. Maybe third time is a charm. And I say, you want to play this game? Let's play the game. We'll give the bulls the benefit of the doubt that we could see a third attempt at cracking the June bottom once again, turning it into support. But if they lose the double bottom formation, they're out of arguments, and the bears will prevail once again. Here's the daily chart for the continuous contract for the S&P 500. it is holding at the most important level, in my opinion, which is 3,600. Even though the volume is moving higher on down days, a bad sign for the bulls. The momentum indicators are weakening, yet again a bad sign for the bulls. But is it the all clear for the bears that we're about to see the flush down? Not yet, because you got 3,600 intact as support. Once the bulls capitulate and say, okay, 3,600 is no longer support, we're done here, you're going to see the flush down. It's going to be a big one. Could the CPI be the catalyst for that happening? Certainly could. We'll wait until Thursday. But for now, here's the Q's 30 minutes chart. What's going on here? Again, the bull flag pattern did not work out, and we talked about the psychology and why yesterday there was a high degree of possibility that it's not going to play out. And instead, we got a gap down, yet the buyers showed up anyways. They closed the gap, but they couldn't close the day above the gap. Instead, we got a reversal, a close at the lows of the day. Again, is this behavior bullish or bearish? The answer is clear. It is bearish. Yet the bulls are going to argue that this could be a double bottom formation. We got a scare at the end of the day from the Bank of England, but once the digestion happens, we will see a rebound tomorrow. You want to play that game? Let's play the game. But after the double bottom is gone, the bulls are out of ammo. And here's the daily chart for the continuous contract for the NASDAQ. And unlike the SPY, the NASDAQ did close below the June bottom once again, indicating and confirming the weakness that we're seeing in technology led by chips. The volume is moving higher on sell-off days. The RSI still in negative divergence. The MACD indicator is in bearish momentum. For now, all of these indicators lead to more pain to come. What happens if we see the flush down Maverick? We talked about targets before in the members program, in the non-members episodes, but here's a reminder for you. If we zoom out, we see the next support at 9,763. What about the IWM 30 minutes chart? What's going on here? The bull flag did not play out. We got the gap down. Same story with SPY and the Qs. But the IWM caught support from 164.91. It gave it a shot all the way in recapturing the support at 168.90, but it could not make it by the end of the day, yet it did not close at the lows of the day. So we have relative outperformance by the IWM. Now the bulls will look at that as, maybe this is a leading indicator that we're going to see a rebound tomorrow, that perhaps the IWM is giving us some hope. And they will argue that this could be an ABC pattern that will take the IWM all the way to 174.22 to close the gap all the way there. If that is the case, it's not going to be the IWM rallying alone. It's going to be accompanied by the SPY and the Qs. This is the bull argument right now. They lose this argument if the IWM moves down tomorrow or in the remainder of the week all the way down to 164.91. And even if that happens, the bulls are going to argue that this is a double bottom that could lead to a rebound. So we're going to play a lot of games here. But for now, who has the momentum? Who has the most solid arguments? The answer is clear. The answer is bears, not bulls. What about the Dixie dollar index? What's going on here? It is moving higher on weaker RSI. What does that mean? It doesn't have the same strength that it did in the previous leg higher. Now, that could be for many reasons. It could be because we have hesitation prior to the CPI. It could be because this is an algorithmic rebound and it doesn't have legitimate legs. And the next leg could be actually to the downside, maybe all the way to violating the trend line. That would be major news for the bulls. Major news to have an excuse to buy the dip in the stock market. But what would lead to such an outcome? The answer is a cool CPI. We're not there yet. And what about the alternative outcome? That the dollar will make higher highs. That could certainly happen after the CPI if it comes out really hot. So for now, the assumption is this leg continues until we get a reversal, until we get a sign that the dollar is about to make lower highs. Keep that in mind. And here's gold. Gold, it is fighting to keep the support at around 1,671. There is a possibility that yes, the bull flag did not play out, but we could see an ABC pattern. But this is the time, and this is the price from which the C leg has to form. And if it doesn't, it means the dollar is shooting up higher and gold will make lower lows. Here's a daily chart for Brent crude oil. What's going on here? Oil bears rejoiced today on the pullback, but the bulls are confident that we knew ahead of time breaking above the sloping line of resistance will produce a massive leg higher. And we got this leg worth about 11.5%. But we also knew that there is resistance at around 98. And it is not out of the ordinary to see a pullback, perhaps forming an A, B, C leg. And the C leg will take us higher all the way to the next resistance at around 105.43. For now, who has the advantage? The answer is oil bulls, not bears. And here's the 10-year yield, the daily chart. What's going on here? It got all the way to the resistance, the previous top. We're now waiting on the CPI. There is still negative divergence on the RSI, and this is what market bulls are really looking at. They're looking at the possibility of a double top. If a double top happens, we see a decline in the 10-year yield, equities will recover. However, what if this is happening instead? What if this is an ABC formation? And after the CPI, we'll make higher highs in the 10-year. That will be bad news for equities. The SPY, the Qs will make lower lows. We will say goodbye to the June bottom once and for all. Who has the better argument, at least fundamentally speaking? The answer is bears, not bulls. And we're talking about equities bears, meaning 10-year yield bulls. They want to see it higher because higher yields means lower equity prices. And here's the TLT, and once again we're using a 30-minute chart, and today we got some short covering that got us all the way to closing the gap, yet the chart did not close above the gap. Does this mean that the TLT goes lower from this point on? Not really. There is still a possibility of a second attempt at closing above the gap, maybe a third attempt. But once the chart makes lower lows, once it starts heading toward 99 and it trades below 99, then you know that this is not going to happen. We have lower lows coming in the TLT. The VIX 4 hours chart, what's going on here? Look at the RSI, it is firming up. Most importantly, look at the MACD indicator. It is firming up. We're seeing these green impressions in the histogram getting larger and larger and larger. Most importantly, the VIX managed to close above 33 for the day. So all of that energy from the VIX consolidating below 33 will now be released to the upside. So the bears have a lot of hope here that the VIX is going to explode. When the VIX explodes, equities go down. The bulls are hoping that today was a panic and the VIX made it above 33 by this panic, but once the panic is over, it goes below 33. Now, for this theory to be right, it has to happen by tomorrow. The VIX has to lose 33 by tomorrow. The SPY has to close in the green by tomorrow. And it has to be decisive, not just closing by a little bit. It has to be a conviction, kind of short covering in the market right before the CPI. What about Apple? Still holding at the same support of 138.79. Yet the technicals, no matter what you look at, be it the RSI, be it the volume, be it the MACD, they're all getting weak and they're all saying lower lows are coming for Apple. Tesla, an hourly chart, what's going on here? We're seeing yet another bear flag playing out, and most importantly, Tesla lost 217.88 as support, which was an important support to keep for the bulls. So what happens after that if the chart continues to go down and we don't see short covering in Tesla? The answer is we have to zoom out to a 2 hours chart this time around, but we see 206.86 as the next support for the chart. And lastly, Bitcoin, tulips. What's going on here? No update. It continues to consolidate within the consolidation zone, aka the launching pad. We're not going to go bearish on Bitcoin and say this is the time to short until we see 18,000 gone as support. Likewise, we're not going to say we're bullish Bitcoin and higher we go until we see a clear piece of evidence that 20,000 is no longer resistance and 20,000 is now firm support. We have yet to get this evidence. For now, Bitcoin remains in purgatory. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have a teaser, a leading indicator for the CPI, and that is the PPI, the Producer Price Index. We also have the FOMC minutes, and we have more Fed zombies speaking. Most importantly, the demon from Minneapolis, Neil Kashkari. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. Now we'll talk to you again tomorrow.
What the VCs wanted to say, good idea, kid. Grown-ups will take it from here. But not this time. This is our time. This time, you're gonna hand them a business card that says, I'm CEO, bitch. That's what I want for you.